Hey everyone, and welcome. Today we're diving into a company that's absolutely vital to the tech world, but one you've probably never heard of: Micromechanics. They're a key supplier in the semiconductor industry, and honestly, their latest financial results give us a fascinating look into the health of the entire chip market. So we're going to break it all down from an investor's point of view. That's so true. When we think about semiconductors, our minds immediately jump to the huge names, right? Like NVIDIA or TSMC. But those giants literally can't do what they do without a whole network of super specialized suppliers. Think of a company like Micromechanics as the one selling the picks and shovels during a gold rush. They provide the essential, incredibly precise tools that make all of modern chip manufacturing even possible. And the scale we're talking about is it's mind-boggling. We're talking about tools so small they're microscopic, but they are absolutely essential for making the chips inside everything, from the phone in your pocket to the safety systems in your car. So by digging into how Micromechanics is doing, we get this really unique pulse check on where the entire global semiconductor industry is heading. Exactly. So to really get why their latest numbers are so important, we first need to get a clear picture of who Micromechanics really is and what their role in this whole race is. Well, for starters, they've been doing this since 1983, which in the tech world is practically ancient history. That kind of longevity really says something. They operate out of 5 facilities spread across Asia and the US, making these hyper-precise parts and tools. And their customer list? It's a who's who of over 600 of the industry's heavy hitters: the foundries, the IDMs, that's integrated device manufacturers, and the OSATs, which are the outsourced semiconductor assembly and test companies. So yeah, they are a deeply, deeply embedded and vital link in this whole supply chain. And that deep integration is definitely showing up in their latest financials. So let's get into it. Let's look at the headline numbers for the first half of their 2026 fiscal year. All right, first up, their group revenue. For the first half of the year, it came in at 35.4 million Singapore dollars. Now, that's a pretty solid number by itself, but for any investor, the real story here is the growth that's hiding behind that number. And this is where it gets really interesting. Look at this. Revenue is up almost 14% year over year. That's super healthy. Net profit and EBITDA, which, is earnings before interest, taxes, depreciation, and amortization, just a key way to measure profitability, they also saw really strong growth. But the thing that really jumps out at me from an investor's perspective is that bottom line: a net cash position of over $27 million with zero debt. In an industry this expensive, having a rock-solid debt-free balance sheet like that gives them incredible flexibility. And get this, it looks like that momentum is actually picking up speed. If we zoom in and look at just the second quarter, their revenue growth actually accelerated to 14.5% year over year. That tells you that this positive trend isn't just holding steady, it's getting stronger. So what's behind all this? Well, the report points to 2 main drivers. First, demand for their high-value consumable tools is at its highest point in over 3 years, which is a fantastic sign. And second, and this is maybe the bigger story, we're seeing a really strong recovery in sales for what's called wafer fab equipment, or WFE. That segment's growth, especially that huge 27% jump from the previous quarter, is a really powerful signal that the whole semiconductor equipment market is bouncing back in a big way. Wow, those are some seriously impressive numbers. But results like that don't just happen by accident. Strong performance comes from a solid strategy. So, what's the game plan here? How are they pulling this off? Let's take a look. It really all comes back to their core mission: perfect parts and tools on time, every time. In the world of semiconductors, where one tiny microscopic flaw or a small delay can literally ruin millions of dollars worth of product, that is not just some catchy marketing slogan. It is the absolute bedrock of their entire business and the reputation. And the way they make that mission a reality is through their 5-star factory program. It's basically their internal playbook, and it's built on these 5 key pillars: innovation, having great teams, being efficient, focusing on the customer, and just overall operational excellence. It's a really disciplined and complete way to run their business at an incredibly high level all the time. And this is not just some corporate talk on a slide. You can see them making real moves in each of these areas. On the innovation front, they're developing new elastomers. These are specialized, high-tech rubbery materials that are crucial for advanced chip packaging. They're investing in new, more efficient machines for their US plant, and this last point is critical. They are building a dedicated team in Arizona. That is a huge strategic move. They're planting a flag right on the doorstep of those massive new chip factories being built there, which is happening largely because of the US CHIPS Act. It just shows they're not waiting around. They are actively getting in position for where the industry is going next. That proactive thinking is super impressive. But, as investors, we're always trying to look around the corner. So what does the road ahead actually look like for micromechanics? Well, I'd say their outlook is pretty realistic and balanced. On one hand, you've got these massive opportunities, like that Arizona expansion and the growing demand for advanced packaging. But on the other hand, they are very clear-eyed about the challenges. They're dealing with the same stuff as everyone else in this industry. Uncertain market headwinds, being really careful with inventory, and of course, that constant global fight to find and keep top-tier engineering talent. And right here is a huge sign of their confidence about the future. They're actually increasing their capital spending to $2.3 million in the second half of the year. The company is very direct about this. It's not just for keeping the lights on. Their report specifically says it's an investment for growth. They are using that strong, debt-free financial position to double down on themselves and their future. And that sends a very, very powerful signal to the market. Exactly. So if we're going to sum this all up, Micromechanics' success isn't just about them riding a rising tide in the industry. They have a clear, disciplined strategy, that whole five-star factory thing, and they're executing it really well. That execution is translating directly into strong financial results and a powerful balance sheet, which they are now using to reinvest in that next wave of growth. From an investor's perspective, this looks like a company that is firing on all cylinders. And that wraps up our look at Micromechanics' latest results. We'll leave you with this important note. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice. Thanks for tuning in.